Hi there, my name is Jordan Lee and I'm a mortgage lender based out of Portland, Oregon. And today I wanted to talk with you about recession and its correlation with home prices or lack thereof. One of the things I hear the most from friends and family when I'm out and about is, "Hey Jordan, yeah, I'd love to purchase a home. It's part of my long-term financial goals, but at this moment, I'm just kind of saving money for a down payment, paying down my student loans a little bit, and getting ready for the next recession when home prices drop. So I'll be able to capitalize on that and make a nice come up." A lot of my friends who are similar age as me, got out of college and went into the workforce when the housing crisis was happening. For example, I bought my first home in 2012, and at that point I bought it for $210,000, and the seller took a $30,000 loss on it because they bought it in 2007 for $240,000. So they took about a 13% drop, which is relatively similar to what happened nationwide on average. And because this happened so recently, it's sort of stuck in our collective memory that oh, recession comes and home prices drop significantly, so we'll have an opportunity to buy a house. History certainly repeats itself, but if we go back just 30 years, you can see that there's not really a super direct correlation between recession and home prices dropping. So in the past 40 years, there's been 5 recessions, and recession simply means GDP is decreasing instead of increasing. Last year, GDP, gross domestic product, increased by 2.9%, and in these last 5 instances where GDP went down, home prices went up 3 of those times. One of the times it went down slightly, and then of course the housing crisis, home prices went down almost 14%. If you want to look at it this way, this is the Case-Shiller index, and in these gray areas you can see our times of recession. So this area, no drop in home prices, this area, no drop in home prices, and then most recent credit crunch, huge drop in home prices. One thing that's important to know is that the housing crisis, there was a lot of extra supply of housing, and there was a lot of loans that were underwritten really poorly with different loan programs that no longer exist. And you can see in this chart here that serious delinquencies were up in some programs almost 10%, and this doesn't even show the non-QM loans or other loan programs that aren't available anymore. But you can see here that in the peak, delinquencies were really high, and now they're much lower. Here's another interesting graph that I thought might be worth looking at. You can see these are loans originated by banks and private institutions, and just look at the volume that was being delivered then compared to now. I mean, it's hardly comparable. There was just a huge supply, and now there's just the supply is much tighter. So we don't really have this bubble that's waiting to burst in housing. Nobody can tell the future, what's going to happen with home prices or the economy, but ultimately, just if you're expecting this, just know that there's not a direct correlation between recession and home prices. Feel free to reach out with any questions. My contact information will be in the comments below.